After my last few videos where I talked about how to invest to become financially free, the most common question I got was, how should I allocate my capital into different risk level financial assets? Should I just simply copy some famous investors' portfolio like Warren Buffett or Ray Dalio's all-weather portfolio? Well, the short answer is it depends. You see, those big investors have billions of dollars under their management, and their main goal is to maintain and steadily grow their capital over a long period of time. They're not looking to double or triple their capital in a short time. And a 10% annual return on their capital will already give them tens of millions of dollars. While a small retail investor with just $10,000 to invest, your goal might be to rapidly grow your capital in a short time. And even if you double your capital in a year, that will only give you another $10,000. So you see, the goals are very different from small to big investors, and that is why there is no one formula fits for all. It really depends on your risk tolerance, how much money you have to invest, and what are the investment time horizon you have. So today I'm going to walk you through those factors I believe they are important for you to consider while you allocate your capital. Hi everyone, my name is Yuxing and welcome to the Wild Finance. On this channel, I share with you my personal investing experiences towards financial freedom. So subscribe to this channel if you also want to learn to be financially free. Now let's talk about those factors. So the first factor is obviously your age and your situation. In general, the younger you are, the more risk you can afford to take. So if you're in the early 20s and you probably just started earning, you might not have family, not have much capital to invest, but you also don't have much debt. And I would suggest you to take more risk at this stage, because even if you lose all your capital, it will be rather fast for you to save up the same amount of capital in a very short time. And you could use the DCA strategy that I talked about in my last video to start building up your initial capital. If you are in your 30s or 40s, you probably have been working for 10 to 20 years and have saved up some capital. You probably also have family and also accumulated some substantial amount of debt like house loan or car loan. So in this stage, it will be wise for you to be cautious. But still, it is important to take a risk. The second factor is the amount of capital you have to invest. In general, the less capital you have, the more risk you should take. If you have millions of dollars, then you probably don't need to watch this video. But if you have less than $10,000 to invest, then I would suggest you to take more risk than you are comfortable with to grow your capital rapidly. And if you have between $10,000 to $50,000 to invest, I would still suggest you to take a good amount of risk. But you need to be vigilant and you need to have a proper take profit and cut loss strategy that can secure your gains and prevent substantial capital losses. And if you have more than $100,000 to invest, which I think it's a really good amount of capital already, then aggressive risk taking will not make sense. So a moderate 10% to maximum 20% allocation in high-risk asset will be appropriate. The third factor is your investment time horizon, meaning when you plan to take out your money. You may want to take some money out for a car purchase next year, or you will take out money when you retire. You should put the money for car purchase in a stable assets because that has a much shorter time horizon than your retirement, which is decades away. So in general, the longer time horizon you have, the more risk you can afford to take, because then you have a lot of time to ride out the short-term market fluctuations. And the fourth factor is your risk tolerance. That plays a key role in your allocation as well. I've talked about this factor in my last video. If you're interested, go watch that video. But in general, if you have low risk tolerance, you may allocate more capital into stable assets even if you have a long time horizon. And if you have high risk tolerance, then vice versa. The fifth factor is your time. How much time are you willing to spend in studying and researching investment opportunities? Personally, I feel if I put time doing thorough research on the investment opportunity, then I understand better the fundamentals of the asset. And I also become more aware of the risk and reward potential of that asset. It actually helps me to hold on to the asset, especially during the sharp downturns. Because if the fundamentals hasn't changed, the outlook is still promising for me, then I have no reason to be bearish, or I don't need to be worried or scared for the short-term price drops. Because those are just noises that I need to tune out. So that's why if you have time to put into researching and studying individual stocks, then you can have a bigger allocation in your portfolio. That's why if you're willing to put more time into studying high-risk assets, then you will be more confident to hold on those assets. And in turn, you can have a bigger allocation into those high-risk assets. Now, let me give you some concrete allocation examples based on those factors we just talked about. Let's just assume that we are building up a portfolio for the long-term purpose, so at least a 5 to 10 years time horizon. Let's say you're in your early 30s and you have $20,000 to start with, and you're able to put $500 every month to invest. If you have low risk tolerance and not much time to spend on investing, then a 20-50-15-15 combo, meaning 20% in high risk, 50% in low risk, 15% in stable assets, and 15% in cash would be a good allocation for you. Then your annual return will be around 15.75%. If you keep doing this for 15 years, guess how much money you will have? $412,314. And if you continue for 21 years, you will end up with $1 million. That should be a very comfortable retirement for you. If you're new to this channel and don't know what are the high-risk assets and low-risk assets, then you have to go and watch my other video where I categorize assets into 3 risk levels. Now let's say you have the same $20,000 to start with. The difference is you cannot put $500 every month. Instead, you can only put $200. But you have a high risk tolerance and you want to spend more time on investing. Then a 35-40-10-15 combo could work for you. Your annual return will be around 22%. If you keep doing this for 15 years, you will have $489,268. And if you continue for 20 years, you will end up with more than $1.3 million. If you're young in your 20s with no family and no capital to invest, and you have a maximum of $100 every month to invest, then I would suggest a 50-30-10-10 combo for you. And you should put more time in study finance and high-risk assets because your educated 50% allocation in those assets can potentially give you the jump start you need to grow your capital quickly. Now, in reality, the market has ups and downs, and it is impossible to have the exact return year after year. But over a long period of time, the market is almost certainly going up. And your average return could end up between 15 to 25%. The bottom line is, if you can save more money every month to invest, then you do not have to take on a lot of risk to reach your financial goal. But if you have less money to invest every month, then you should study those high-risk assets because in the long run, it can provide you the same return. Well, this is obviously not financial advice. You should always evaluate your unique situation and your risk tolerance before you allocating your money into any investment. Now, you may notice that I always allocate some cash position in my portfolio. And the reason is the market never goes up in a straight line. Even in a bull market or an uptrend, the market corrects from time to time. And when a correction happens, it is a good buying opportunity to scoop up some undervalued stocks. It is like the Black Friday sale. When the stocks are on discount, then we should definitely do some aggressive shoppings too. So if you have cash at hand, then it's a perfect buying opportunity for you. But if you do not have cash at hand, then you can only watch those discounts passing by. If you're interested in learning how to do the technical analysis to spot the uptrend or the downtrend, then subscribe to the channel and also spread it among your friends. I will make some video related to that when I reach 200 subscribers. Yeah, you heard right, 200 subscribers, it's still very little, and that's why I need your help. Please do help me out.